Hello and welcome back to Global Value. Today we're performing a fundamental stock analysis of VeriSign Inc., ticker symbol VRSN. We're looking at VeriSign today because it's in Berkshire Hathaway's public equities portfolio and it's also in Terry Smith's Fundsmith portfolio as well. So given the position sizing at Berkshire making up less than 1% of their stock portfolio, it's likely that this was either an investment from Todd Combs or Ted Weschler, the other two investment managers at Berkshire Hathaway in addition to Warren Buffett. However, this has been a long-term Berkshire holding, so it's going to be interesting to dig in and learn more about the business and to understand what the people at Berkshire and what Terry Smith like so much about VeriSign. So currently the business is trading for $200.66 per share. Over their last year, their stock price is down 8%. So even though this is down, this is actually outperforming the S&P 500 over this time. Over the last 5 years, VeriSign's stock price is compounding at a rate of 11% annually. Over their last 10 years, their stock price is compounding at a rate of 16% annually. And going back prior to the global financial crisis, over the last 18 years, VeriSign's stock price is compounding at a rate of just under 12% annually. So VeriSign is currently trading $28 below their 52-week high. They're up more than $45 from their 52-week low. VeriSign's a large business. They have a $21 billion market cap. So for more background about the business, VeriSign is the sole authorized registry for several generic top-level domains, including the widely utilized .com and .net top-level internet domains. The company operates critical internet infrastructure to support the domain name system, including operating 2 of the world's 13 root servers that are used to route internet traffic. In 2018, the firm sold off its security services business, signaling a renewed focus on the core registry business. The company also has back-end systems for .cc, .gov, .edu, and .name domains, as well as operating distributed servers, networking, security, and data integrity services. VeriSign Inc. was incorporated in 1995 and is headquartered in Reston, Virginia. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of VeriSign based off of their business fundamentals. So this analysis is still an evolving and improving process. It's a work in progress, and it serves as an opportunity to learn in public. So it will continue to get better and improve over time. With that said, let's get right into today's analysis. Starting things off here with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that the average publicly listed business earns about a 7% return on capital, and the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. So VeriSign's return on capital numbers are just off the charts. They're pretty insane here with their lowest return on capital of 164% in fiscal 2021. This has to do with a couple of factors here, including the nature of their business and how the accounting is done for their business. One thing to be mindful of is that even though these are really insane return on capital numbers, it's not like this company is able to reinvest large amounts of capital, but they are earning very high returns for the capital that is able to go into the business. Averaged out over these last 5 years, VeriSign's earning about a 246% average return on capital in a typical year. So that's nearly an order of magnitude better than a typical business. This is an insane check here on metric number 1, but it has to do with some of those factors for their business and the limitation of redeploying more capital into their business. Next up for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric will be all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. So over this time frame, VeriSign has grown their revenues by 17%, their net incomes are up by 16%, and their free cash flows are up by 21%. So this is modest growth across the board here for VeriSign. All 3 of these are up, and this is a check here on metric number 2 as well. It's great to see that while moderate, their free cash flows led this growth, because free cash flow is really the lifeblood of any business, and ultimately a business's abilities to produce free cash flows now and until judgment day, discounted back by some reasonable interest rate, is what that business is going to be worth. So a business can use its free cash flows to buy back shares, pay down debt, pay dividends, make acquisitions, or reinvest back into the business. Again, it's great to see growth here for VeriSign, especially with their very high returns on capital. Next up for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at VeriSign on a per share basis. So we're looking for earnings per share growth over the last 5 years. So as noted in our previous metric, their earnings have grown modestly over this time frame and likely a benefit for long-term shareholders in the business. VeriSign has bought back 12% of their shares outstanding in the last 5 years. This is important because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that business. So when a business buys back stock by decreasing the number of shares that they have outstanding, they're increasing your ownership percentage in the business, which will ultimately increase the percentage of the business's profits that you're entitled to without you having to spend a dime. So it's almost as if the company is making a partial acquisition of itself. And so just like with any other acquisition, we want the company to be getting more value than the price that they're paying. So in practical terms, this means that we want businesses that are buying back their shares when their stock price is trading for below the intrinsic value of the company. You'd want to dig in here and have your own understanding of the business to really understand that in more depth. However, between their earnings growth and their share buybacks, this has led to strong earnings per share growth for VeriSign. This is a check here on metric number 3, and in their most recent fiscal year, the company earned $6.24 for each share that they had outstanding. Next up for metric number 4, here we're looking for something similar. So we want to see free cash flow per share growth over the last 5 years for the business for pretty much the same reasons that their earnings per share were up over this time frame. This is also going to be a check here on metric number 4. Their free cash flows have grown modestly, and with their share buybacks, this has led to strong free cash flow per share growth for VeriSign. In their most recent fiscal year, the business produced $7.45 worth of free cash flow for each share that they had outstanding. And it's nice to see that their earnings and their free cash flows per share are roughly the same here, averaged out across this time frame, because over extended periods of time, meaning 10 plus years or more, if there were wild fluctuations in these, especially if their earnings were much higher than their free cash flows consistently, that could point to either some sort of structural limitation in the business in terms of its cash conversion, or even something more extreme and nefarious like fraud in the case of Enron or WorldCom. While some businesses can manipulate both their earnings and their free cash flows, it's typically harder for companies to manipulate their free cash flows. Painting with a very broad stroke, that doesn't seem to be the case here for VeriSign, as it looks like these two are in pretty good shape and VeriSign seems to have a very high cash conversion. So to recap where we stand currently, we are perfect through our first 4 metrics. We have 4 checks for VeriSign. Next up, for metric number 5, here we're evaluating how the business utilizes debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over thetheir last 5 years. So VeriSign currently has an $814 million net debt position, and over this time frame, the company has produced $6.3 billion worth of free cash flow. This is way more free cash flow than what their current net debt position is. This is a big check here on metric number 5, as it looks like the company is very cash flow generative relative to the debt that they're employing in their business. And the company would need just over 1 year's worth of free cash flows to be able to pay off all of their net debt. So it would seem like their balance sheet is in very healthy position here. We're still perfect through our first 5 metrics. Let's see if VeriSign has what it takes to be a select 6 stock and go a perfect 6 for 6 on our analysis. So our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this may potentially offer us a reasonable starting point for a valuation of VeriSign, and it may offer us a slight risk premium to the yield of the 10-year treasury. So we're using their total enterprise value because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of VeriSign that's more similar to as if the business were a private company. So currently, VeriSign has a $22 billion total enterprise value, and we learned in the previous metric that the business has produced $3.6 billion worth of free cash flow in their last 5 fiscal years, meaning that in an average year, the business produces about $725 million worth of free cash flow in a given year. So when we divide their $725 million of their average free cash flow by their $22 billion total enterprise value, that gives us about a 3.3% average free cash flow to enterprise value yield for the company. So that is coming in below the yield of the 10-year treasury, and that's a couple percentage points below that 5% risk premium as well. So unfortunately, all the way at the end here, this is going to be our first and only X of the day on VeriSign. Worth pointing out too is that the business produced $803 million worth of free cash flow in their most recent fiscal year. So to get a current free cash flow to enterprise value yield for the business, when we divide their $803 million of their most recent fiscal year's free cash flows by their $22 billion total enterprise value, that gives us about a 3.6% current free cash flow to enterprise value yield for VeriSign. So that again is also slightly below the yield of the 10-year treasury and below that 5% risk premium as as well. So it looks like both of these are falling short here for VeriSign. So just because this is the case doesn't mean that you're going to toss this business out in its entirety. This is one of our 6 metrics, and this is not meant to be financial advice. While these metrics are simple, they're meant to be holistic in nature, and when combined together, they can be very powerful. Plus, VeriSign seemingly had some very strong aspects of their business reflected in their financials in our previous metrics. And so even though this is our final metric, you'll want to stick around until the end of the video because there are some very interesting aspects of the business left to cover. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze VeriSign, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for VeriSign. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with VeriSign's current free cash flows and using historical growth assumptions based off how the business has grown their free cash flows over the past 20 years in order to project these out into the future. So it's up to you to determine whether or not these historical growth assumptions are going to be accurate and applicable going forward to give us a baseline projected estimate for VeriSign over their next 20 years. If we assume that the business can grow their free cash flows at a rate of 12.5% annually for their next 10 years, and then assume that that growth rate gets cut in half for the 10 years out after that, so their free cash flows would only be growing at a rate of 6% annually in years 10 through 20. We won't be adding in the company's tangible book value because that's going to be very skewed based off how the accounting is done for their share buybacks. Since 2005, VeriSign has bought back more than 50% of their shares outstanding. So if you had been a shareholder in the business since that time, you now have 50% more ownership business in the company, and it would be similar to as if the company gave you an extra half a share for each share that you had outstanding. So using these assumptions, if we were seeking a 15% rate of return from VeriSign, then based off today's current valuations of the business, it looks like a reasonable fair intrinsic value for the company is right around $105 per share. This is down $95 from the business's current stock price. Keep in mind that we're using this 15% rate of return because that's the rate of return that Warren Buffett is ideally seeking from his investments. This is in addition to his margin of safety requirements, which depend on the dynamics of the industry that the company operates in, as well as that business's competitive positioning within that industry. It won't be the case that every company in Berkshire's stock portfolio is able to meet this 15% hurdle rate all the time. The pricing of companies fluctuate, and this isn't to say that Berkshire could have gotten a 15% rate of return from when they first bought into the business. Keep in mind also that a discounted cash flow model is really based off the predictability of a business's future free cash flows. VeriSign has tended to be a pretty highly predictable business in its past. That's not necessarily a guarantee for the business going forward, however. So it's really worth diving into VeriSign if you're interested in the business. Please be mindful of the fact that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in summary, VeriSign checks the box on 5 of our 6 metrics today. It looks like the company is very strong in terms of its attractiveness for further research. VeriSign earns insane return on capital numbers due to the nature of their business, plus how accounting works, especially with their share buybacks. The business has grown their revenues, earnings, and free cash flows modestly over the last 5 years. That growth, in addition to these 12% share buybacks, has led to very strong earnings per share growth. The company also looks like it's using a very reasonable amount of debt relative to how free cash flow generative the business is. Our only X of the day came on both an average and a current basis of their free cash flows when we were comparing those to the yield of the 10-year treasury, as it doesn't look like there would be that slight risk premium we'd ideally be seeking through VeriSign at today's current prices for the business. Finally, performing a discounted cash flow analysis of VeriSign, if you've done the work and you believe that those historical growth assumptions are going to be accurate and applicable going forward for VeriSign, and you are ideally seeking a 15% rate of return from the company, then it looks like at today's valuations of the business, a reasonable fair intrinsic value for VeriSign is right around $105 per share. The last time the business traded around those prices were back in September of 2017, so there are reasons why that may not be potentially accurate for the business going forward. So it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about VeriSign. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand the ins and outs outs of that company and understand what's important and what's not important for the business going forward. As you learn about the business accurately, completely, and then go back and ask yourself, what did you miss, in order to understand the essence of the business. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of VeriSign, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of VeriSign Inc., ticker symbol VRSN. We looked at the business today because VeriSign makes up a small portion of both Berkshire Hathaway's public stock portfolio and Terry Smith's Fundsmith portfolio. Plus, with the business checking the box on 5 of our 6 metrics, it looks like VeriSign is a very strong candidate for further research, so I'm happy to make an analysis of the company. And if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about VeriSign with me, and have a great day.